Hello, everybody. We're joined here today with Nicole and Croft with GenCore Mortgage, and we're talking about the mortgage market and what it means for the real estate industry as we look ahead to 2023 and what could be in store for next year. So 2022 rather, has been a very interesting year for the mortgage market, where we've seen so many increases in interest rates. Really, I can't remember a year quite like this. Where we've had so many increases in rates, and we've just had another one here by the Bank of Canada. And I'm curious, Croft and Nicole, what do you think about this latest rate increase, and what do you think we're looking at for further increases potentially in 2023?
Nicole, why don't you take this one?
Okay. So I think we'll probably have to wait and see. The deputy governor of the Bank of Canada spoke today in Montreal and mentioned how that's exactly what they're going to be doing. They're really going to take this as a data-driven exercise in January to see where the economy is going, what's happening with inflation. I do think it would be a smaller rate increase if that did materialize in January.
Yeah, the comment I would make further to that is that, the housing market's probably a third of the GDP for our country, maybe a little bit less than that, or slightly below 30%. And with what's taking place in Toronto and Vancouver and how much of the interest rates increases to date and the impact that they've had on housing activity, particularly new construction in those two cities, I think the bank will be very cautious about, even though they're trying to manage inflation and that's their primary function, if they can see a reason for slowing down the increases or leveling them off, I think they will, because they're going to be under pressure with how little activity is taking place in housing in our two major markets.
Right. Okay. So certainly we wouldn't expect another year like we've had in 2022 heading into next year, right? I mean, is the general consensus that if there are further increases, there will be more modest than what we saw at the beginning of this year and through the bulk of the rest of the year with so many steps upwards in the key lending rate?
Yeah, I think that's right, Brett. It's not. I mean, I don't think we're going to face anything like we faced in the 1980s or early 1990s when rates went to 14 or 18%. I mean, those rates were coming off of 5 or 6% and then tripled up to 15, whereas now the rates are coming off 1.5 or 2. So, in effect, it's the same exponential change, and it's kind of a triple in the rates that they've done. So I agree with Nicole's comment that I think it's going to be data driven, but it's going to depend on what's taking place. But I think there's another 0.25% maybe, but I think it's going to start to level off. And then the other thing that's taking place that's quite important for the outlook is that the interest rate curve the yield curve right now is inverted. So short-term rates right now are in a very unusual position, and it happens usually before recessions, which is another thing to talk about with rates next year. But with the inverted curve and 2 and 3 year rates being so much higher than the 5 and 10 year rates, that they're really predicting, at least the bond market traders are predicting a recession next year, which should leave towards the end of the year into 2024, where rates will start to decline.
Right. Very good. Okay. So, I mean, if we've got purchasers that kind of feel like, they're on the bubble a little bit in terms of affordability, and, we're seeing, inflation slowing, which is slowing down the increasing in house prices, but it's now more expensive to borrow. And so not necessarily a ton better with respect to affordability. Some of the things that we've seen used in the past for purchasers that are trying to qualify for that little bit more house, it could be things like extending the amortization of the loan that they're looking to qualify for. And in some instances, perhaps given the uncertainty with the outlook for interest rates, perhaps opting for a shorter term fixed rate loan and say the 1, 2, or 3 year range rather than the traditional 5 year. What do you guys think about that? Do you think that's going to be more on the table within the mortgage brokerage community in 2023 as borrowers try and find a way to make mortgages happen for themselves?
Yeah, Nicole? I think definitely that's something we're sort of seeing at all times, really. People are really trying to buy as much house as they can. And when we are facing higher interest rates, which translates into a higher qualifying rate, and then again, house prices that have increased, it's sort of a double whammy for borrowers coming into the market. So things like if you do have your 20% down and thinking an extended amortization is going to help, that's definitely something they can talk to their mortgage professional about. Extended amortizations on the insured side, obviously that's not something that's an option for those borrowers. And I don't really think that there's an appetite for changing that anytime soon. But yeah, I mean, there's definitely some options out there for borrowers who are looking to jump into the market.
And I mean, if you've got a 1, 2, or 3 year fixed term loan, I mean, is the qualification process the same for a shorter term loan like that as it is for the traditional 5-year mortgage rates? Or would the bank consider that more or less risky and need more stuff from a purchaser? Or what's the approval kind of regimen like for a shorter term loan like that?
So the process is exactly the same as it is for a 1, 2, 3, or even 5-year rate, depending on what they decided to go with. Like Croft mentioned, right now, what we're seeing is higher rates in those 1 to 3 year rates versus the 5-year. So people might sort of initially ask about that 2-year rate, and then we tell them what it is, and they think, well, actually, maybe I'll stick with the 5-year. Right. If fixed rate is something that they're really keen about.
Right.
Yeah, just to elaborate on that just a little bit, Brett, and clarify. So with the 2 and 3 year rates being higher, and people have to qualify at 5.25 or the contract rate plus 2. Mm-hmm. So if we have a 3-year rate now, let's say of 5.4 or 5.5, that means people would have to qualify on a rate based on 7.5, which would reduce the amount of mortgage. And I know they may be concerned about where the 5-year is going over the next 5 years, but we have 5-year rates right now that are underneath 5%. So let's say we have 4.75 on a 5-year rate, people would be qualifying then at 6.75. So they would get a substantially larger mortgage if they take a 5-year term. So right. It's a bit of a juxtaposition in what you would think, and that the rates, the 2 and 3 year rates are typically lower, but they just aren't right now. Right. But there is another option, is that there are a couple of lenders that are non-stress test lenders. So if the people have put 20% down, they are able to qualify based upon the contract rate with a couple of the lenders that we have access to. And then they're able to qualify on a typical like $120,000 a year income. People might be able to get as much as $75,000 or $80,000 more mortgaging if they take a non-stress test lender. And those lenders, the rates are very competitive with the banks, but they're not unattractive, but they can get a much bigger mortgage if they investigate non-stress test lenders.
Very good. Thank you for that. I mean, I'd always been under the impression that the shorter term loans were less expensive for purchasers, but sounds like that's changed a little bit right now, and that the rates are comparable or even a little bit higher for shorter term loans. Is that fair to say?
Absolutely. Right now, the 3 months to 3 year on the yield curve are significantly higher than the 5 to 10. And in most circumstances, it's exactly the opposite. The further you go out on the yield curve, the lower the higher the interest rate, because they're anticipating you're lending the money out, there's more risk over a longer period of time. And right now they're seeing more risk in the short term, and the shorter term rates are higher.
Right, very good. So, I mean, we've talked a lot about qualifying for new homes and buying houses, and we spend so much time about that, particularly here in a real estate sales channel. But no doubt you're going to have, a lot of homeowners that got a great deal, say 4.5 years ago, when they were purchasing their property and maybe locked in at a 5-year rate that would be considerably lower than what they would be facing, looking into next spring and next summer. So could you provide us with any advice that you might have for borrowers that are holding mortgages right now and are maybe a little bit antsy about what their new mortgage payments might look like, into next spring and next summer. Is there anything that they can do to get ready for that, or any advice that you might have for someone who's facing an approval at a much higher rate for their existing mortgage?
Yeah, so I think the main thing for borrowers would be to plan ahead, and to make a budget would be the first thing right off the bat. Second of all is going to be plan early. So your lender is going to send you a renewal offer with an interest rate, and talk to your lender, talk to a broker, get a second opinion to say, is this reasonable? And then if you are in difficulty, even before your renewal comes up, and this goes in any situation, talk to your lender. Don't hide under a rock. Go talk to your lender.
Yeah. Further to that, there's a couple of other strategies that can help. A lot of people don't understand, because the government changed the rules in 2016 and 2018 about the source of funds for mortgage companies, and in changing those rules, there's the ability to get what's called an insurable mortgage, and insurable rates are much lower than the conventional rates often are. But recently last week we had some folks that were quoted 5.54 from their bank on a 5-year renewal, and we were able to get them an offer of 4.84, and it was because the mortgage was considered insurable. So it's really important that people talk to a mortgage professional, because it's not just talking to your own lender, because if you talk to your own lender, happens to be a bank, they're not going to explain to you that there are other options in the marketplace that are significantly cheaper. So if people had an insurable mortgage when they bought the house, if the mortgage was put in place before October of 2016, it can be grandfathered into being called an insurable mortgage. So, and also if it's just a switch, it can be considered insurable if you're not looking for new money. So the important thing for people to remember, Brett, is that you need to understand that your mortgage can be classified in a way that can open up much lower rates that are insured and sold into the mortgage-backed security market. And people won't hear that story from their own bank. The other thing that's important for people to understand is that in facing renewals is that we're in a higher rate environment. So in all likelihood, rates are liable to go down. So as rates go down over the future, they may be thinking about, the thing you're mentioning about shorter terms might be attractive. But if you're getting into taking a renewal, who you take your renewal with or who you switch to is very important, because payout penalties are going to become more and more important as we go into the future as rates are dropping.
Yep.
So having an interest rate differential from a posted rate or an interest rate differential from a discounted rate can make tens of thousands of dollars on your payout penalty. So talking to a professional about understanding what payout penalties are like are very important when you come up on a renewal as well.
I mean, that's great advice, guys, and we could talk for quite a while. I'm sure we'll talk again, as we get into the busy season next year and see more transactions happening. The one bit of advice there that you both of you mentioned that I think is really relevant is to get ahead of this, and to consider all options. Particularly with speaking with a mortgage broker that can get you that insight. I mean, I've had the experience in previous fluctuations within the market where whenever there seems to be volatility, it also seems to yield more product selection and a greater level of importance of really understanding what's available to purchasers. And you guys have always been so great for that. So we thank you again for coming in and supporting the channel here today. So that's our mortgage kind of outlook here for 2023. I mean, I'm sure we'll have you guys back again as we turn the corner here into the new year and start to see how things are going to play out heading into the spring. So Croft, thank you very much. And Nicole, thank you again for taking time with us here today.
Thanks, Brett. It was great to see you again.
Take care.